CMQ investors, welcome to the show. It's great to have you here. Please don't freak out because we didn't have the intro music or basically the same intro that we've had for all of our 27 episodes, at least up to this point. The reason for this is because this episode is unlike any episode of the CMQ Investing podcast that has ever existed. The reason for that is we've taken the audio from an Instagram live broadcast that I did through the Instagram account Charlie Munger Quotes. When I asked everyone who had taken part and who had asked me questions and just been really engaged, I said, hey, should I make this an entire podcast? Everyone said yes. So I am here to serve you as a fellow CMQ investor. I just want to give you what you want. And if you like listening to this and you're not mad that I'm saying or that it's not perfect, well then, hey, let me get out of the way and give you exactly what you asked for. So appreciate you supporting CMQ Investing and spreading the word. Thank you for all the ratings and reviews. Please don't hesitate to do that if you haven't thus far. Don't forget to follow us on Apple Podcasts and or Spotify or wherever you're streaming your podcast for that matter. Now, with all that said, let's dive right in. Test 1 2 1 2 1 2 1 2 1 2. What's up, everybody? I'm actually recording this as a podcast while we're doing this live. So I'm taking your feedback. I'm applying your feedback. Hope everybody's having a good Sunday. We've got not a lot going on here today. It's been I've been working on some business stuff. I've got it's kind of a dark, gloomy day in New York City, but as you can see here, I have my I have to get a sticker to go into this one place in order to show that I'm vaccinated. So that's what New York City's like right now. I know I posted something kind of unintentionally political about masks, or maybe it was about vaccinations, and I wish I didn't do it because some people were really mad about that. I didn't realize like how polarizing that issue is, because in the city here, no one really has an issue with the vaccination because COVID was so bad here. So everyone was just happy to be able to go outside and do regular things. But anyway, just thought I'd do this differently. As I said, I'm recording this for our podcast right now, so that way the audio will be at the same level. I see somebody. I can't have people join as video. I just don't know. I don't know if people are going to come on and, have their shirts off and things like that. So if you're trying to do that, I'm not trying to keep you away. But there's some weirdos out there, as I found out. Even people that follow Charlie Munger Quotes, which you wouldn't think would be, you think everyone's like an upstanding individual. And most are. We've got a pretty good crowd. But, there are some crazy people. The podcast is called CMQ Investing. It's weird because I post about it a lot, so it's funny how the algorithms work. You can find it on iTunes or Apple Podcasts. It's also on Spotify. It should be on Google. It should be everywhere. But check it out. It's getting great reviews. It's all organic, so I think in the coming weeks we'll start, maybe promoting it a little bit more, and that'll be cool. But this is the setup right here. It's all really good quality. There's some skits in there. I see you, Bobby. What's up, Bobby? People like it a lot. So if you do listen and you do like it, make sure to leave a review. If you haven't subscribed already, do that, because that way you won't miss a single episode and you'll get the information before everybody else. And, look, we're still early here. I think what we're trying to do, I'm stretching, we're trying to do is find the truth, surface the truth about investing and make sure that we reinforce it and look at what's going on now through those lenses, or that, kind of the Munger, Buffett lens, Bogle, Howard Marks, the legendary investors. Do I have a financial day job? Technically, no. I'm an outsider who got, in the game and has basically, for a living, what I do. I am to put it for all intents and purposes, I run a very specialized marketing firm where we do really aggressive customer acquisition for a lot of startups that have, become unicorns, some Fortune 500 companies, some Fortune 10 companies. So I'm sort of like this behind the scenes, depending on who you talk to. I'm like the man behind the scenes that's putting up numbers that no one understands how I'm putting them up. And so I allocate, a lot of money for a different reason. It's very creative, but it's also very quantitative. And so, when I got into investing, as I started, having more money to invest, I decided to start. Someone just said, "Why are you impersonating Charlie Munger and catfishing folks?" I should go on the show Catfish and be like, "I thought it was Charlie Munger," and I just show up like, "Hey, um, rip off my face like, hey, it's me, Charlie. Um, sorry, that made me laugh. Thanks, Scott. So anyway, I'm doing a bad job of describing what I do for work because I'm a little bit kind of behind the scenes about it. It's not sketchy or anything. I'm not here to promote that, but I crack codes for a living. I figure out how things work, and then I make it work. And so I decided at one point, after being really into investing as a amateur investor, that I wanted to take that same part of my brain and just dedicate time out of my day to mastering or coming. You never master it, but trying to master how the stock market works, how wealth is created, and really just elevate my game. And then COVID happened, and I was in New York City. And so then I had, I work very diligently for my business, but then I had all these extra hours where I'd usually, have some social time, you know what I mean? And so I just went, when I get into something, I just go all the way in. In some ways, I think I relate to Charlie Munger like that. And I think I accelerated my investing wisdom quite a bit, and I'm just into figuring out how stuff works and seeing what people miss. I really enjoy, piecing stuff together, taking it apart, seeing the patterns, and for whatever reason, I seem to be really good at it. I'm not saying for investing, but just in life. In my day job anyway, I've always been doing what I guess you call growth marketing or building audiences, building customer bases, and it's very much a performance-driven thing. And so I built a business because I said, it's going to be about who has the best numbers. I'm in New York City, so there's a marketing agency every 2 blocks. So I'm in a very competitive space, and I've been very fortunate. I've been able to, carve out my niche and work with great companies. One of my clients, who I was very involved with, helped acquire 1 million customers in a year for less than, I think it was 90% less than the industry. They were acquired by Goldman Sachs. And then Goldman Sachs had me on for about 2.5 years through several different contracts. And again, I was just, they brought me in versus any of these giant agencies. And, that's a place where it's all about your performance. No one cared. I'm a nice person. I get along with people. But it was because I could get way better numbers than everybody else. And so, when I realized being in Goldman, not that, there was people there who were quants that were looking at me like I was intimidated by them. And then I found out they were intimidated by me. And so it made me realize, like, wait a minute, I think I could get good at investing. Anyway, I could talk more about that some other time. I don't mean to just rattle on, but I get that question a lot. People want to know, what I do. And like I said, I'm not a charlatan. I'm not some guy trying to, who just sounds like they know what they're talking about. I'm really into this stuff. So hope that helps. I think last time someone asked me that, by the way, I jokingly, I was like, I have an OnlyFans. And then everyone left the live. Now, so ask me some questions. What's going on, guys? It's Sunday, so I didn't know who'd be on. I'm getting caffeinated right now, so I could start sweating here at any minute. Let's see what we got going on here. Appreciate everybody commenting. Yeah. All right. Awesome. Thanks, guys. Andre, appreciate that. I'm still laughing at Scott's comment. I'm going to try to wave back. I realize that the podcast, this is going to sound weird on the podcast, but, we're trying different things. And I guess I could take this video too. Oh, wait a minute. This means I'm going to become a YouTube influencer now, right? Here's Charlie. Have you read Damn Straight? Yeah, actually, you mean Damn Right, Ruben. I think that's what you mean, right? What Ruben's talking about is Damn Right. It's the I almost said Beyonce. It's the biography of Charlie Munger, and it's by Janet Lowe. I actually have book notes on that at on our newsletter at Substack. If you go to cmqinvesting.substack.com, they should be there. You should be able to read them. Sign up. It's free. And I took really diligent notes when I read it. It's a great book. I wish the title wasn't so long, because it's tough to be like. It's called Damn Right: Behind the Scenes with Berkshire Hathaway Billionaire Charlie Munger. That's the name of the book. Yes, Poor Charlie's Almanac. I actually am using that book as a stand for my iMac right now. So I love that book, and I have a digital version too. So I will sometimes go back to that. Great book, and I highly recommend buying it because it's a great coffee table book. It looks really nice. It's just a great. It's like a work of art, and I'm not just saying that because it's Charlie Munger. It's just a great a great book to flip through. What did I major in college? I was a comm major in college. I was actually on the investment group. I forget what it was called. My freshman year. So I've been interested in investing for a long time. I was quickly elevated to some sort of senior position because my friend and I knew someone who was the president of a publicly traded company, and we got them to like call in for the meeting. And then the investment group ended up investing in this company. But I really didn't know much about investing back then, but I've always have been interested in it. Something that's cool with Charlie and even, Warren Buffett is they don't really apply a lot of the collegiate, like the academic modern portfolio theory stuff to what they do as investors. They don't really believe in a lot of the standard dogma, that's taught in academia about finance, which I found that to be really interesting, as I got to learn more about them. For example, and we have an episode about this, about how Warren Buffett redefined risk. The kind of like academic definition of risk is volatility. It's beta. I think that's what it's beta, which means like volatility. So if something has a lot of volatility, that's seen as, oh, that's risky. Whereas Warren Buffett's logic was, no, risk is actually losing all your money. And so if you can stand volatility, then it completely changes your perspective on what would be an attractive investment. And furthermore, I'm writing an essay. Furthermore, when you don't have these short-term goals or benchmarks that a lot of the professional investors have, or they have clients that are like, how do we do this year? When you can think and operate on a longer time scale or time horizon, you're at an advantage. So it's about changing your perspective and then being able to see things and then do things that other people aren't able to do and can't do. And I think that was something that I found very, very cool as I have been learning more and more about them. What's up, Cameron? Appreciate that. Let's see what else we got here. Chris, Cameron, I'll check it out. What did he say? I see Chris, the Big Blue Book. What did you major in college? What did I say? I know I'm always kind of saying funny stuff, but what did I say? Okay, not a question, just a funny off-topic comment. Today you posted the quote about a tank of gas. Hey, Ruben, I saw that. Did you respond to me about that? Because I was quickly checking this. Yeah, it's funny. I mean, again, they're not the same guy, but that's a good point. That's a good point about the snowball is that book, and I have it right here, actually. Hang on. Oh, there was all the books. The Snowball. You realize Warren Buffett was kind of like a little badass. You got to read that book, and he was, he was a little thief, a little criminal, Warren. No, it's just funny reading about him, and he's just very. The book is very honest about just him and kind of his little quirks. I found it to be, it's an awesome book. If you haven't heard the story of how I found that book, I'll tell it to you really quickly because that's what these are for. I don't know. This was probably back sometime in the wintertime or maybe the late winter. There is a bookstore here. It's a famous used bookstore, and there was a thing on the news that they were at risk of going out of business because of COVID. And so I saw that, and I was at the office, and I said, I'm gonna head down there and buy some books. And I go down there, and I was first of all realized it's crazy how lazy we've gotten with Amazon. I was like, where do they have this book? I'm looking through things manually. Ended up picking up a bunch of books, one of which was The Snowball, which, the algorithm on Amazon has never recommended to me. And it's an awesome, awesome, awesome book. We've referenced it a few times in the podcast. Yeah, another thing that Charlie Munger does that's really funny is if you've read that book, you'll be walking with him somewhere, and you'll be done with a conversation, and he won't say goodbye. There's a story where he's with Warren Buffett in New York, and they're walking side by side, and the next thing you know, Warren Buffett looks over and Charlie Munger was getting into a cab. Didn't even say goodbye. And it's like his personality. He wasn't trying to be rude. He can just be very. I think they call him he can be like an absent-minded professor. I just found that to be pretty funny. He was probably borrowing Charlie's car. That's good. Would you guys know the story with Charlie Munger's yellow car that he got after he got divorced? I won't tell it if you guys already know it. So the story is after he was divorced, he got the crappiest yellow car that he could find. And it wasn't just because it was yellow, but it was a crappy yellow car. And I think it was his daughter asked him, Dad, why do you have this car? And he said to keep the gold diggers away, which, I mean, again, that's genius. Also hilarious. You're not blocked. I don't know why you think you're blocked. Saying to Signor. In LA, there's a place called Huntington Library. Munger's daughter is a board member there. They have a lot of great books like the Almanac. That's good to know. I love LA. I hear LA is a bit of a mess right now, but I usually get out there pretty often because I'm a movie star playing Charlie Munger in a Charlie Munger biopic. It's called The Rational Man, starring Chris Franco and Scarlett Johansson. Any advice for a young 22-year-old wanting to get into investing? I think just learn as much as you can. Don't try to pick individual stocks, at least not yet. Really, if consistently contribute to some sort of equity-based index fund, I think that's pretty smart. If you have any sort of tax-deferred account, fill that up first. But again, learn as much as you can. It's a long, long process. And again, unless you're doing it professionally, you have to find your own time to do it. And I look back, I keep pretty good, logs of decisions I make and things like that. I've got a lot of little mental tricks and tools like that. And going back and reading things that I thought were smart, or why I'll write down, why I bought something, meaning a stock. And one of the biggest epiphanies I had, and I'll just share this with, what was your name? I just want to make sure I get it. With Andre. And so this was probably, 5 years ago. And I don't know if it was 5 years ago. It feels like 5 years ago, but I was, I was into Charlie Munger and Warren Buffett, and I was loading up on a couple different names, doing the whole concentrated bets. And I thought I knew some stuff. What I didn't know at the time was that I hadn't mastered my psychology. And, I think this one particular name that I bought, which was a great pick, it had a really bad, some stuff came out in the news. It was really bad. And the market got scared, and it went down maybe 25%. And, it's one thing to say, you just got to hold on through the volatility. You can do it. I was not feeling that. And I, cut my loss right there. And that was a mistake. That was a bad decision. But I realized in that moment that, one, I hadn't mastered the psychology yet. And two, I didn't like the kind of investing where I had to check my portfolio every day. I realized it just didn't feel good. And around the same time, I got familiar with the low-cost index funds. And I think there's a Warren Buffett quote about, dumb money ceases to become dumb when it realizes its dumbness. And it just, all put together. And so I got into a Vanguard, low-cost index fund. I was looking at it yesterday. I mean, that was one of the smartest things I've done. And so it was also one of the most simple. And it's something that I think a lot of people can benefit from. I'm not giving you financial advice. Do your research, but something to think about. Would you say Charlie Munger is the biggest person you aspire to? Wow, that's awesome. I mean, in some ways, for sure. I think that's definitely. I created the page, just because I'd gotten so much value from his ideas and quotes over the years that I thought that in some ways, like, his quotes were viral. Like, he says stuff that just kind of cuts through, and there's a lot about him. I try not to, be overly, we're all people, so no one's perfect. But I'd say, he's definitely a hero of mine, if not in terms of non-family, and everything else. I think I think very similar to him. I'm not saying I'm at his level, but the idea of being in a lot of different disciplines and these things, like his little idiosyncrasies and things that work for him that, other people don't do, that he does because they work. That's always, since I was a little kid, I was like that. And, you're constantly told you have to do it the same way as everyone else. And I was always finding my own way that worked better. And there was something that I feel like with Charlie Munger, it really reinforced that. Like, oh, you can do this and it can work out, and actually it was probably one of the first people I came across that was like that. And I wasn't interested in it because of investing initially, but also just because the rationality. I think that was something that really resonated with me, because I was always trying to be more rational. And my thing with the page was I just wish I had, discovered him sooner, right? I think it was 2015. And so I thought with the page, if this catches on at all, it'll help some other people find out about him sooner. And that's a good thing. And kind of going back to one of his quotes, the best thing a human being could do, finish that sentence. Everyone's like, to help another human being no more. So that was, and again, I was locked in the apartment during COVID. So it gave me a mental escape too. And it's turned into, a newsletter, this podcast. It's been awesome. So, okay, let's see here. Have you seen any of their meetings, Berkshire Hathaway? I have not been, but I'd said I'd like to go to this next one for sure. But I've not been. I've probably watched or I have read the transcripts of every single one, which isn't the same as going, but that's, let's see what else here. Thoughts on the Daily Journal. I don't own any, but that doesn't mean it's not a great company or it's a good company. I think it's probably, look what Charlie Munger has said about it recently. The price right now is definitely well beyond, what it is. Probably I don't want to get into I don't want to say something where, you take my opinion on this as like the financial fact, but I didn't find the price to be attractive, but I definitely think I watched their daily meetings. I watched the annual meetings. I've read the transcripts of the old ones. It's cool. It's really cool. And again, he's 96 years old or 7 years old, and he's the chairman of that company. I mean, if you watch the most recent one, he's locked in on it. I mean, he's into it. He's not like, not into it or kicking his feet up. He's very actively engaged. Let's see what else. Bobby, I agree. I didn't want to say that because it just seems like kind of morbid, but I agree. Bobby said, I hope they stay alive. And I hope they do too, man. I think in some ways they both exceeded what they thought they would be, because I've seen old interviews and things where, I don't think that anyone really expects to live, into their 90s. At least, you don't, I shouldn't say that, but if you were born in the 1920s or 1930s, getting to your 90s is not, statistically, it's not a huge probability that happens. All right, I recently found out how to go by purchasing Berkshire B. Yeah, I mean, I think could you go without owning Berkshire B even? I feel like, would they turn you away? Maybe. I mean, because I feel like if you fly out there, I guess if you're going to buy a plane ticket and fly out there and get a hotel, you might as well buy at least a share. You know what I mean? It seems like kind of backwards. You're like, no, I'm a big fan. I just flew out here though. Well, why don't you buy a share? I do own Berkshire B. Berkshire is awesome. I mean, it's such a cool company. Maybe cool is not the right word, but it's it's what they built is something that I think people don't realize the full extent of it. Because I'll see comments sometimes. It's like they talk about those guys, meaning Charlie Munger and Warren Buffett. They talk about them like they're supposed to be, like they're just stock guys, like they're just buying, like a hedge fund manager. And it's like, no, I don't think people realize that the reason they buy publicly traded companies is because they can't find any, businesses to buy all of. So they go to the public markets. That's just what they do with the extra cash, a lot of the cash that comes in through the insurance business. It's a heck of it's a really, really, really smart, ingenious way to build a business. And the way they manage it is just very different. It's, decentralized management, and that's not in the blockchain sense. But they let the managers do the thing, and there's not a lot of employees at headquarters, but there's Berkshire Hathaway. I think they're the 7th largest business in the United States based on revenue, bigger than, I think it might even be bigger than Google on a revenue basis. Don't hold me to that, but there's a lot of big name companies that they're bringing in more than it's a giant company. Okay. Initially I got into Warren as a teen looking to get rich. Now it's 20 something with much milder goals, just enjoying. Yeah, man. I think, I was always and still am ambitious, but, you just got to keep plugging away. I think that's the key. Keep plugging away. I agree. This is a great community. That's what Signor said. I was reminded recently to say the questions or say what I'm reading to, because if I play this back later, if we upload this, it'll just sound like I'm just talking. Charlie also, this is from Ruben. He said, Charlie also stated one shouldn't aim to be a billionaire. Exactly. He didn't. He just overshot. Exactly. And I think I heard a couple different guys I follow, athletes, they were saying, I want to be a billionaire. Excuse me. And there's nothing wrong with that, but it's just not a good goal. I think, because I'd rather know why. If you said I want to, I want to help the world, or I want to, build hospitals in third world countries, and so therefore I want to be a billionaire. Like, okay, but I think just aspiring to be a billionaire, it's a pretty empty goal, and I say that only because when you become a billionaire, if the goal is to be a billionaire, you have I'm sure a moment of, you do the, the Tiger Woods fist pump, but then it's like, okay, now what? I'm not a billionaire, by the way, so I don't know if I'm like, when you get to that point, it's very depressing. You're like, oh, okay. Charlie also, he has great advice for your life, not only investing. That's what Hoffling Mark just said about Charlie Munger, and I totally agree. And that's one of the reasons I think just continued to be a fan of his and read everything and watch all his interviews and videos, because he, there's so much going on in the world, so much going on in our minds, and sometimes when you hear someone say something that's so simple and true and succinct, and you just know, like, oh, and a good example would be that quote, the best way to get what you want in life is to deserve what you want in life. To me, I heard him say that, and I was just like that's like 100% true. And it helped me a lot, actually. I just started my business, and I was, I had this calendar on my wall, like a real physical calendar. And every day, it sounds kind of corny, but it was great. Every day, I mean, I was working, like, I'd get home, crash, get up, go. Like, I'm hitting the pavement in New York City, just trying to make something happen. And every day I would draw like a little smiley face to represent, like, did I deserve it today, basically. And it was just knowing I was putting in that, that I was exhausting myself every day. There would be no excuse for this business not to work. I recognized that I'd been part of startups that, for no reason of mine, didn't work out. Stuff happens. And what I decided was, I'm okay if the plane goes down, but I have to be the pilot. I don't want to be the first officer. I'm done doing that. Like, let me at least fly the plane. And if it crashes, I can deal with it. But I want to just be able to say that there's nothing that, it wasn't out of my control. And so when I started my business, that was such a mentality of mine was, I accepted the fact that there's a chance of failure. Starting a business, and in any city, it's hard. I think 50% of businesses fail within the first 4 years or something like that. And, but I knew that if I look back and said, I know I left it all in the field, or left it all in the court, if I deserved it, if I put in that work, I couldn't be mad. I could deal with it. I could cope with it. And so, yeah, that helped me a lot. So yeah, to get what you want, you need to deserve what you want. I don't have tattoos, but I feel like if I did, I'd have one that says, like, be more deserving or something like that. And then I'd have Charlie Munger face tattoo. Okay, let's see what else we got here. All right. Let's see here. It's like 350. Okay. Being more, what do you have in your portfolio? So I give all my money to a guy named Bernie Madoff, and this guy is great. The returns, they're consistent. They just keep on coming. So, no, that's a very untimely joke, but, I have a lot of, passive index. So I do VTSAX, individual names. I've had Apple since 2014. Tim Cook knows me on a first name basis. I've got, and these are some, like, things I've held for a long time: Alibaba, Microsoft. I'm forgetting Berkshire B. I started buying that when I was younger. I'm probably forgetting some names, but I try to primarily do passive indexing, but I have a portfolio that's for I call it the focus portfolio, and I again the other one is Chewy. So Chewy was one that I really knew, when you know something and kind of what they talk about. That was one where I got it at the right time. It's taken a little bit of a beating now, but again, I'm bullish on the long term, but I'm also recognizing there's a risk too. I'm definitely forgetting some. I'm not trying to keep it from you guys, but as I should say, do your research. It's very hard to pick stocks. It's very hard. Warren Buffett himself doesn't recommend people do it. And also, people will point to Warren and Charlie. It was so much less competitive when they were doing it, when they were, really in the, the money management game or asset management game, if you want to call it that. The reason that, passive indexing is so successful is because it is really pretty much impossible to beat the index in terms of active management. Just is, it's to beat the market. It's not really feasible. I mean, there's some people that do it, but that do it consistently over a long period of time the probability is very, very, very low. And that's for professional investors, meaning guys and girls that do it, 16 days a week or 16 days a week, 16 hours a week or a day, 6 days a week. There are buildings of people down the street from me that are trying to beat the market professionally, and some of them aren't able to do it. So the idea that, we're somehow have some insight just by casually observing, the market, it's our overconfidence. And so if you're going to buy individual stocks, really make sure you evaluate the business, you read 10Ks, and just know that in all likelihood, our approach is the passive approach is one that over a long period of time, it's hard. There's very little evidence that shows that's not the best way. The CMQ and CMQ investing is compound money quietly. And, it's all about the time that you're investing, the amount of money you're putting in, and then the average annualized rate of return. So, your goal should be to have your money compound, for as long as possible at the best possible rate. And so kind of like Charlie Munger said about being a billionaire and he just overshot, I don't even try to beat the market. I just want to get the market average. Most investors fail to do that. The average investor does about 4 or 5 points below the average, which is kind of mind blowing. So the name of the game, and I think what's coming out of this content and what we're all about, and it's a Munger thing too, is trying to make less mistakes than the average investor. Because if you make less mistakes than the average investor, you can do better than average or the average investor. So, all right. Surround yourself with successful people. What do you have in your portfolio? Simon Sinek, what's your why? Is that a question for me about what's my why? Have you noticed that Charlie's behavior is quite similar to the Stoic ideal? Yeah, I have noticed that actually. Thanks, Adrian. That's from Adrian. I have noticed that. I don't think it's for any reason other than just, we put names on stuff. But yeah, in one of the biographies I've read about him, that's one of his, I think it was one of his kids said they kind of wished he'd be a little more like, not emotional. That's not the word, but just if something goes wrong, he avoids it. He's like done with that. Like I cut it off. And that can be a very good coping technique, and you avoid a lot of trouble. But, sometimes you have to kind of like work things out. I don't know. I don't want to put words in like, his son's mouth, but it's in one of the books, but it's that stoicism. But I've also read that he's not as stoic as he appears on stage. That's kind of an act. Him and Warren's little shtick at the Berkshire meetings, like it is a shtick. Okay. Stonks. Someone said stonks. All right, guys and girls. Appreciate everybody chiming in. I didn't know on a Sunday what this would be like. And as I said, I'm recording it from on the podcast as well. So the great idea with the movie. Thanks, Signor. Signor's got all the comments, man. I appreciate it. Definitely have got to get some new quotes up. I've got to try to get a bunch more reels up this week. Those reels, by the way, they reach a lot of people. Instagram is loving reels, and it's been fun to take some of these quotes, and I can track down the original clips and put those up because I think it's a cool way to spread the Munger wisdom, because people are discovering it that they don't even know who he is. One thing I did that I'm going to stop doing because I realize it attracts a little bit of the wrong crowd is I put billionaire Charlie Munger, just because I know that people that see that that it's like immediate credibility, like, oh, he's a billionaire, rather than just like a 90-something-year-old man telling you how to live. And but I think with that you get some people who are there for like the how do I become wealthy by like by tomorrow, that kind of thing. And so I think I've noticed some comments later down the road that are or there's the folks that are like I shouldn't say this, but I'll just say it. Let me be real. People that just like hate people who make money, and they assume that like him and Warren are evil guys, and just because they see that he's a billionaire, they don't know anything about them, but they make these assumptions. Or I'll post a quote that was not said in any sort of weird way. Like I posted one about like I don't have any fears, and it was like a kid not a kid, but someone at the Daily Journal meeting was just saying like, what do you worry about? Like what are your fears in life? Because everyone has them. It wasn't like people read it like I fear nothing, but he was just saying at my old age, like my fears kind of melted away. He wasn't trying to flex. But someone commented, it's really easy to not fear anything when you're a billionaire. And yeah, it's just kind of funny the way people interpret stuff. Let's see what else. How many books have you read about Charlie? Because I feel I've exhausted the Charlie YouTube clips. Need to get into the books. Definitely get the books. I mean, there's not a lot of books about him, Ruben, but damn right for sure. Poor Charlie's Almanac. I mean, there's speeches in there that you can find online, but that's a great one to have. I think in the Snowball, actually, I was going to make a post for this of like all the times that he's mentioned, because he's got very funny cameos in there. I think I'm trying to think what other books. The Warren Buffett portfolio, he's definitely a big part of. That's one of my favorite books for investing, by the way, if anyone hasn't read it. Hello, sorry if I say your name wrong, Rajvan. Seeking Wisdom, he's a part of, and he's brought up a lot. It's called Seeking Wisdom from Darwin to Munger. That was a game-changing book for me. That book, I think, set me on a really good course. What's up, Greg? He says, working on the weekend. This isn't work, Greg. Greg, this is just Munger rational time. We're just hanging. I was saying I have my my vaccination sticker. What other books, guys? I have some right here. Hang on. This is Seeking Wisdom. I bought this book. I don't really know. I didn't know Naval that much. I didn't know much about him, but I saw a book that was kind of using the Charlie Munger. It's called The Almanac of Naval. But to go back a couple steps, the Poor Charlie's Almanac, that's an ode to Poor Richard's Almanac, which was something that Ben Franklin produced. So Charlie Munger, his two biggest heroes are Warren Buffett. No, I'm telling you, it's the coffee, and I'm trying to do four things at once. His two biggest heroes are Benjamin Franklin and Lee Kuan Yew. And so I would joke with a friend that, when I talk about Charlie Munger, I put the instrumental to Eminem's Stan on, like my tea's gone cold in the background. Well, and, it was funny because Charlie Munger actually has busts in his office, like those, statue heads of Ben Franklin and Lee Kuan Yew. So Charlie Munger would not look down on me for making a quotes page. He wouldn't be like, oh, this is some fan. I think he is similarly finds something that works and he really, gets into it. Lee Kuan Yew is a hell of a man, says Rational Moose. That's what it sounds like. He's got some great quotes. If you want to read some great quotes, just type in Lee Kuan Yew quotes. I have his biography. I've yet to read it because it's just in my queue, but it's like this thick. Any psychology book recommendations? Absolutely, Adrian. I might have, what do I say off the top of my head? Give me a second. There's definitely Influence by Cialdini. I think any psychology textbook is worth flipping through. I don't think you can go too wrong there. There's one called The Art of Thinking Clearly that has a lot of different cognitive biases in it. Seeking Wisdom has a whole section about that. I'm trying to think what else. I've read a lot, and I read a lot of academic studies about psychology because it's something that I've always kind of naturally understood, but it's done. I was into this before I found Charlie Munger. Like I read Influence, and it just stuck. And so when I remember watching one of Charlie Munger's videos, and he talked about how that book was so important to him, and he actually, you guys might not know this, but when he read that book, he sent Cialdini, the author, he sent him a share of Berkshire Hathaway as like a thank you. So he really liked that book. There's another one that I think I might have it in my briefcase. It's by Cialdini's one of the authors, but it's called I think it's like The Art of Getting to Yes or something like that. Okay, have you read much about Li Lu, says Ruben. I have, but I haven't nowhere near as much as I've read about, Charlie or Warren or, some of these investors, but it's on my list. Something I'm trying to do is I really try to stick with something for a while and really know it. Cause I get really curious and excited. So otherwise I could fly through all that stuff, and just jump around, and it doesn't stick the same way. But yeah, Lee Kuan Yew keeps coming up, and Charlie Munger he's a real fan of his. Like Charlie Munger is like the ultimate fan. If Charlie Munger was into sports, like if he was a football fan, he'd be like, his whole body would be painted. You know what I mean? He's like one of those guys. Okay. How do you reconcile, this is from Gareth. How do you reconcile conflicts like BYD's low ROIC and Munger's quality? I think I don't know BYD in and out by any means. And feel free to elaborate if you want me to get more specific, but Munger's quality business characteristics. I mean, the biggest thing is a durable competitive advantage. Obviously, try to get it at a fair price. But in terms of the low ROI, return on invested capital, now I could be wrong about this, but I would imagine, well, two things. One is not every metric is going to by itself be an indicator. You know, a company could have a really high PE ratio, but actually there's a reason for that. And if you dig into it, it's not bad. At the same time, you know, if a company doesn't have a high return on invested capital, that might not be ideal, but it could be something that's just because they're accelerating growth now. Because if I'm investing, if I want to keep putting more and more and more capital in because I'm trying to, you know, basically get ahead and be the leader, then I might not have the best return on that capital in the short term. I don't know about BYD specifically, but I think anytime, you know, I think with Charlie and Warren, they're not as they're quantitative, but they don't stick to stuff like formulaically. They don't really use, everyone always wants to know like the Warren Buffett, you know, his approach to valuing businesses and how he measures it in the formula. And Charlie said that we don't use one. They're looking for things that are so obvious that you don't need that. With that being said, I think a lot of the math is, you know, Warren can do in his head. But I think you need to look at the big picture. And I think, you know, the qualitative side, which is, I think, a Charlie Munger's very skilled at that in addition to the quantitative side. But the qualitative side is where BYD probably has some aspects of it that are, you know, seem to have paid off. Now, I have a great BYD story, though. So there was a Bloomberg article. This was it could have been a podcast episode. It just didn't feel like it was enough, but now I have a reason. So it was something about, you know, Warren Buffett, his BYD pick paid off. And the reason he did it, or a big reason, was Charlie Munger. And Charlie Munger identified the CEO of BYD. He said he's a mix of Jack Welch and Thomas Edison. And, you know, if you guys know about how many biographies that Charlie Munger reads, that's something that he'd be able to connect. And I just want to find this, bear with me here as I'm trying to do 80 things at once. But it was, you know, again, where you talk about having a good partner. So it's from August 9th, and I'm going to try to read this to you. I've got this camera right in front of my face, so this is going to be challenging. Okay, let me scoot around a little bit. Bring this over here. Okay, it says that Warren Buffett gets lots of investments rights. Ugh. I'm like, I can't read. You guys are like, oh my God, I'm talking about all the books I'm reading. I'm like, okay. Warren Buffett gets lots of investments right with his patience and deliberate buy and hold strategy. And it's becoming apparent that he's doing it again with electric vehicles. By the way, this sounds like the podcast. For investors pouring money into the technology, it would be wise to consider how the sage of Omaha has looked into the future of the sector. The value of Berkshire Hathaway's holdings in BYD, one of China's oldest makers of cars and automotive batteries, has skyrocketed this year. BYD's share price is up almost 30%. Buffett has backed BYD for over a decade, holding around 22% in the Hong Kong listed company, which now sits on a market capitalization of over, and this is in like Hong Kong, whatever their currency is. Again, I don't know. It's the equivalent of $117.6 billion US dollars. That's more than investor darling NIO Inc., the new generation Chinese automaker listed in New York. So how is that different from the rest of the EV universe, which just keeps on surging? BYD is more than just another upstart to take on Tesla. It's getting closer to mastering the right technology for EV batteries, the core of the electric car that accounts for almost 50% of the price and is crucial to widespread EV adoption. And that's what Berkshire has honed in on. Here we go. Charlie Munger quote? No, it's a Charlie Munger cameo. Longtime Buffett partner Charlie Munger had spotted the genius of Wang Chuanfu, the chemist and researcher behind BYD, leading to Berkshire taking a 10% stake for around $230 million in 2008. Guys, you got to start hitting those hearts because just like Charlie Munger. In a 2009 Fortune magazine cover story, Munger described Wang as a combination of Thomas Edison and Jack Welch, something like Edison in solving technical problems and something like Welch in getting done what he needs to do. I have never seen anything like it, said Munger. That's turned out to be quite a prescient call. Wang understands batteries, Getting the chemistry right would determine how well cars equipped with these powertrains would and could do. It's given his company a leg up as the rest of the sector stumbles through recalls and battery fires. Super interesting. BYD electric cars are chunky and don't carry the techie coolness of new generation cars like Neoinks or Tesla's Model X with its Falcon wing doors. And side note, and it's driverless. What is it? I can't even think of the name of it. It's with their self-crashing cars. That's what it's terrible. I shouldn't make jokes. Sorry. Tesla, our new self-crashing car. But it does have the right price and safe battery technology. It's now China's largest EV maker, selling more cars than the competition in the mainland. BYD has doubled down on making affordable batteries at scale and has bet on the technology to achieve that goal. At its 2020 annual results, the company said it would stop plans for the nickel cobalt. I tell you, I definitely don't know much about batteries. Manganese battery adoption, which most cars and battery makers are set on. Instead, BYD has turned all its attention to so-called lithium iron phosphate, or LFPs, for its so-called Blade battery, which was released earlier this year. Notice how they said so-called in the same sentence twice? Are they skeptical about it? The so-called podcasts and so-called Charlie Munger quotes page. Here, I just lost it. It just went away. Hang on. I have stuff in front of my screen, and I'm not wearing my glasses, so I'm really showing out here. Hang on. It's like passing an eye test. Okay, so where were we here? With the so-called, it says Wang's focus on LFPs is turning out to be a game changer. It's cheaper and more readily usable. The chemistry is far more stable than up-and-coming NCM type. Okay, blah, blah, blah. We don't care about all these nuances. I'll post this link somewhere. But here's what it says, and going back to that question about BYD. It says BYD commands almost 15% of the battery market in China, behind contemporary Amperex technology. Globally, it could end up with a 3% share in the electric vehicle market by 2025, according to an estimate by my friends, or an analyst at Goldman Sachs. BYD's battery deliveries for its own cars and external sales could reach 30% of industry consumption, Goldman notes. Car makers, too, are realizing this is the way forward, or at least until other options can be commercially produced that don't result in frequent battery fires. Tesla is testing BYD Blade battery for its Model Y, and the likes of Volkswagen AG, for their part, want to make their own powertrains. Even for one of the world's largest car makers, this is a challenging task, unlikely to yield results anytime soon. Berkshire's recognition, this is the last paragraph, Berkshire's recognition of Wang's expertise and the value of battery chemistry has turned out to be a win for now. If Wang and his company can stay ahead of the competition with evolving EV technology, BYD could be a model for investors to keep an eye on. That, more than the fascinating but distant plans of some car makers, is the kind of realism that caught Buffett's eye. Pretty cool. At least I thought it was cool. Let's see what you guys said. So, Garrett, thanks for that question. You just sparked a really cool, I remember that article from earlier last month, and there we go. Adrian says, many thanks, wonderful recommendations. I assume that's about the books. I'm glad you liked them. I'm glad that was helpful. Ruben says, wasn't Charlie Munger not a fan of Welch? Remember him saying the GE culture was off? I think that's possible. I think he talked about the earnings could be sometimes not manipulated, but he has said positive things too. So I wouldn't say he wasn't a fan, but I'm also not totally sure. He obviously thought highly enough of him in regards to his get done what needs to be done attitude, as that article noted. Charlie says Warren always talks about discount cash flow. Is that what you mean? Yeah. But he's never seen him do one. Yeah, that's right. That is right. Is that Franco Moran? Am I saying that right? Is that is your name Franco? Because everyone calls me Franco, so that's pretty cool. I know I've seen you before. Garrett says, thank you. You are spot on with BYD being a jockey bet, A+. Oh, thanks, man. Also worth remembering it was a value play when they bought it. Absolutely. Great point to say that, because I think a lot of times investors who are younger like us will see something that Berkshire is into, and they'll say, oh, I want to add that to my portfolio because look, Warren Buffett owns it or something like that. But, look at when they first bought. They bought Apple in 2016 when Apple wasn't, a darling stock by any stretch. So it's easy now to say it's also another point here, which is it's easy now to say that, oh, Apple, that was so smart. But people weren't but they weren't sure about Apple in 2016. And let me read you guys something. I posted this through the newsletter. I'm just remembering it now, and I realized this is like the perfect place to talk about it. IG Live is a game changer. And check this out. Glasses. They're like all smudged. I'm like, all right, let me find this for you. 1 second here, folks. Yeah, Franco Moran. My last name is Franco, and my whole life everyone has called me Franco, so that's cool. Okay, I called this "What Stocks Look Like Apple Did in 2016" by Chris Franco. In January of 2016, Fortune, meaning Fortune magazine, called Apple a risky stock. Later that year, Warren Buffett bought 10 million shares. Berkshire Hathaway has since made $100 billion from the Apple investment. This all made me think back to this members-only post, and this is what I wrote in that. I said, I love how I'm like Chris Franco said, the best time to buy a great piece of a great business is when the consensus doesn't agree that the business is great. And I'll say that again just because it's kind of a tongue twister. The best time to buy a piece of a great business is when the consensus doesn't agree that the business is great. And I wrote, it's easier said than done, but the logic is bulletproof. So the question remains, what stocks look like Apple did in 2016? And I wrote, my key takeaway is that great fundamentals and low expectations equal a potential opportunity. Great expectations, I am all over myself with this. It's the coffee. I swear it's the coffee. I don't drink a ton of coffee anymore. And when I do, and I think because I'm excited to talk about this stuff, I'm tripping up. But it says great fundamentals and low expectations equal potential opportunity. So just take that as a little bit of a nugget of wisdom, at least that. And that for me, by the way, is not me trying to like be preachy. That was I made that connection as someone who's constantly and aggressively educating myself, about investing. And as I said earlier, if you joined earlier, figuring this stuff out the way that I figure algorithms out and figure these things that I realized that I could direct my brain towards and that it wasn't impossible to figure out. I think a lot of the investment world stuff it's getting to know the language and then realizing that there's so many ways that are deliberately set up to mislead us as individual investors. There's huge, it's not even just financial literacy. It's almost like street smarts because, as I had a podcast, we did an episode about some fine print in a asset management company's contract. And I didn't have this follow-up yet, but I actually took all my money out of that firm. I moved my entire retirement fund over to Vanguard because I dug in even deeper and I was offended. I was pretty ticked off about it, and because I felt like I got duped. And thankfully I spotted it now because I could have gone on for decades paying a wrap fee, on my retirement to basically have them put me in passive index funds. And I know that was this effort, doing this, creating this content, just being passionate about this. It's already paid off. Like that decision, I don't need to try to monetize this. I don't need to try to sell you merch. Although buy the merch. No, I'm just kidding. But anyway, and that's what I hope that, the content can help people do is just start to understand things and see, be able to see it more clearly. And it's hard to write like, what's the value proposition? Because I'm getting to know everyone and we're getting the sense of kind of like what we're all trying to do. But, I just thought I'd share that. Pretty shocky how people rip off retirees. Yeah. And, but I think there's also incentive clause bias where a lot of the folks in that industry, they don't think they're ripping off people, because that's just like, well, no, we charge 1.5%, but it's not cool. If you know what you're doing, there are people that look, if you're paying an advisor because you need someone to stop you from selling when the market goes down, there's reasons for it. And some of these companies have other services. I'm not trying to say like the whole industry is bad or, and plus that attitude is not going to get us anywhere. Like, oh, everyone's they're ripping us off. I don't think I'm more into trying to resolve things than, be like adversarial, but, it's just, I can see both sides of it is what I'm trying to say. I can see both sides of the argument. But for me, it was like, why am I maxing out a retirement account? And basically you're doing what I can already do. And I'm being charged a 1.5% wrap fee in addition to the expense ratios on whatever funds you're putting me in. And why wasn't I told that there's other alternatives? When I brought this up, they were immediately like, we could put this in a brokerage fund. And I don't want to say that's not the specific about the retirement, but there was another account where I was getting hit with a 1.2 or 1.25% fee. That's where I'd been purchasing Apple since 2014. When I didn't have a lot of money or extra savings, but I was doing responsible things with it. It was all my direction. I didn't need, why was that in an account with a wrap fee on it? That's ridiculous. And when I brought it up, they said, oh, you know what we can do? You're right. Let's put this into a brokerage account. It's like, why didn't you give me that option from day one? Right? Like that's where I was. And again, the relationship, the trust is gone. So I said, adios, I said, give me my money. I sent Jimmy, if you guys listen to the podcast, I sent Jimmy New York over there. Jimmy, baby. Jimmy New York, making sure no one gets scammed. All right, Garrett says, some of Munger's investments seem higher risk than Buffett's. Have you come across any Munger blowups? When he was in, okay, I'll read you something actually right now. It's from Warren Buffett's lecture at Columbia. I think it was 1984, and it was reprinted. And it was his rebuttal to the people that said the efficient market theory was like, was perfect, or the market was perfectly efficient and no one could beat the market. He described I think 9 different investors who all followed the Graham approach to value investing. And I want to read you what he said about Charlie Munger, and I think I'll be able to answer that, Garrett. One sec. Okay, hang on. So it says, he points out, one sec, it said, Table 5 is the record of a friend of mine who was a Harvard law graduate who set up a major law firm. I ran into him in about 1960 and told him that law was fine as a hobby, but that he could do better. He set up a partnership quite the opposite of Walter's. His portfolio was concentrated in very few securities, and therefore his record was much more volatile, but it was based on the same discount from value approach. He was willing to accept greater peaks and valleys of performance, and he happens to be a fellow whose whole psyche goes towards concentration, with the results shown. Incidentally, this record belongs to Charlie Munger, my partner for a long time in the operation of Berkshire Hathaway. When he ran his partnership, however, his portfolio holdings were almost completely different from mine and the other fellows mentioned earlier. So he's different. If Charlie Munger had a theme song, it'd be that 2 Chainz song, I'm Different. I think it's called I'm Different. I don't know if anyone knows that song, but I think this is the first time that 2 Chainz and Charlie Munger have ever been said in the same sentence. So just want to go on record, call that out. And look, yeah, I'm sure he's made mistakes. You can't be an investor and not have blowups. The key is to have a margin of safety, and not put yourself in a position where you can't come back. And a lot of people do that. I think that's part, you could tell people to do that, hey, we have a margin of safety, but they don't do it. What helps me a lot is just reading why people make these mistakes, why we all do. And one of the big root causes is overconfidence. It's a killer. You'll hear me say it a lot, and I say it a lot not to drone on about it, but because I think we need to repeat these ideas. I've done studies, I read studies on how we remember what we learn, because if we're continuous learning, we might as well learn better. And it's spaced repetition over time. So it's good that we repeat this stuff, not to just drill it in, but these are big ideas that really work. So overconfidence is a killer. And overconfidence will get you to trade too much. It'll make you think you can beat the market, or think you know something, and trying to buy and hold and get in and out of positions. But you can also be overconfident in other people. Like, I think plenty of people are overconfident in Cathie Wood's ability to predict the future. I've mentioned before Robert B. He's the master of disaster. He's got 6 decades worth of studying and evaluating major national disasters, like things that happen when the oil tankers blow up, or a rocket ship crashes, terrible stuff like that. And, when he was asked, what's the lessons of your whole career? What's the root cause of all these terrible disasters? And he says, hubris and greed. And, hubris is on that same branch with overconfidence. And greed, obviously, we have to be careful about as investors. I know I've crushed the market with all this low interest rate stimulus world that we're in, but I don't think that it's, that somehow I'm Warren Buffett. And, something I've been looking at really closely myself right now is, do I want to am I overexposed in equities right now? Or is it not that I can time the market? I'm not saying that, but just making sure I'm not taking more risk than I have to right now. Let me read you guys a new article from Jason Zweig from the Wall Street Journal. It's kind of on that same note, and it's a good reminder just to kind of, it combats that overconfidence. It combats that sort of like, hey, this is just going to keep stocks only go up, because they don't. And speaking of another great book that I'm just about done with, A Random Walk Down Wall Street. Awesome book. Highly recommended. Good luck for this channel. Thank you. I hope you're liking what I'm talking about. It seems like we got a little crew in here right now. It's not bad for a Sunday. And then we'll post this as a podcast. We'll see how that comes across too. It's going to be very different than other episodes. Maybe I'll do some ad libs. I'll have, when I mention Jimmy New York, I'll have him pop in. All right, let's see. I'm going to find this for you guys real quick. The next thing I have to do on YouTube is where you can see my screen, right? So I'm like, I'm like the little guy in the corner. I'm sure that makes a ton of sense. For anyone listening without the video, it's like they're, the little guy in the corner. Brad, real estate. Not saying you should do that. I'm saying that I bought real estate about a year ago because it was like, it just made sense. Not because I think real estate's going to be my best investment, but because it made sense to, diversify and actually get to live in some equity, rather than just look at a piece of paper. Hang on. Let's find this. Jason Zweig. Jason Zweig, by the way, he's the man. That guy, he knows it's like a historian, and he's just got such a good approach. He's not like trying to sell anything. He's very, very rational. Okay, the article though, I have a lot of subscriptions that a lot of these are behind a paywall, so I hope it's okay that I'm just reading them, but it's from September 3rd, and it's titled, What You've Lost in This Bull Market. Investors who no longer fear their bets could explode are seeking out risks they don't have to take. Everybody pull up a chair. All right. I'm just laughing. This is, if you could see this setup right now, my dogs are somewhere looking at me just like, bull markets give and they take away. One of the most valuable assets created by this bull market is the distinction between risk-taking and risk-seeking. You can't invest at all without taking any risk. Even if you keep 100% of your money in treasury bills backed by the U.S. government or bank accounts insured by Uncle Sam, that isn't risk-free. You run the very real risk that at today's paltry interest rates, the income you earn won't maintain its purchasing power. Net of inflation, you are highly likely to lose money. Double. That's an involuntary risk, one that no investor in those assets can avoid. That's when I would have Connor, the overconfident investor. If you guys know the podcast, he'd be like, "Not me, buddy. I'm all in." You can't invest. Okay, that's an involuntary risk, one that no investor in those assets can avoid. A long bull market, however, goads many investors into taking voluntary risks. They seek bets they don't have to make. Here we go. Ready for this? Sad story. Consider Robert Gilmore, 69 years old, who lives in the Dallas-Fort Worth area. He's been trading wait till you hear about this guy, by the way. He's been trading full-time since late January. At one point, he says, he was using about $200,000 in margin or borrowed money and held as many as 160 stocks, sector funds, and exchange-traded funds. Sorry, I'm not making fun of him. A number he calls ridiculous. So he knows it's ridiculous. Mr. Gilmore has scaled back, no longer trading heavily on margin. He's down to 96 holdings, but he can't seem to stop. On August 30th, Gilmore spotted Zoom Video Communications stock falling sharply in after-hours trading. So Zoom was going down in after hours on August 30th. So Gilmore says, and I quote, "I said to myself," sorry, I'm just going to laugh, "I'll just load up and make a killing tomorrow when it goes back up." He recalls, the next day it went down 17% instead. And I took my usual bath and swore never to do it again, says Mr. Gilmore, until I saw Wells Fargo was down that night. So I bought it and I paid the price the next day when it fell another 5%. Get this, a retired accountant, Mr. Gilmore logs all of his trades, several per day, in a spreadsheet. This is nuts. This is what I hope our content, if somebody who could be him would just like come across and this would save them. They're like, oh my God, like we're the AA for this kind of investing. He said he logs all his trades in a spreadsheet. He's made about $18,000 in profit since he began trading full time, but says if I just parked the money in some index funds, I'd probably be up a lot more than I am. Yeah, you for sure. And again, he says this with a laugh, so he understands how ridiculous it is, and I'm not making fun of him. He's probably listening right now, and he's trading right now. He's can't wait for the market to open on Tuesday. He says it's not such a good way to invest, maybe, says Mr. Gilmore, but it has kind of become my life. That isn't so surprising. The S&P 500 has closed at new all-time highs 54 times so far this year, making it seem almost as if the market will never go down again. And people often take more risk when the environment around them feels less risky. That's a really good nugget, guys, and everyone. I don't mean guys, like whatever you want to, fellas, gentlemen, ladies, everyone, children, boys, girls. People often take more risk when the environment around them feels less risky. I'm going to repeat it for myself, but hopefully for you too. People often take more risk when the environment around them feels less risky. If I did post-production on this as a podcast, by the way, my head right now, I'm imagining Connor, the overconfident investor, just doing something he shouldn't be doing. And I can't wait to start making those skits. I'm talking about our podcast, CMQ Investing. If you're listening to this or watching this, it's on Apple Podcasts, Spotify. Check it out. So I think we have 25 episodes. They're short. They're packed with knowledge. I've worked really hard on them, and I'm trying to make them better and better as we go. And there's some, kind of goofy little skits that are worked in between. Like you'll be listening and it's very serious, and then something will catch you off guard that I've been told is people, they find it really funny. And hopefully it makes these topics more, more people can get into it, because it's not like this, it's not super boring. Okay, you guys want me to continue? I will. You probably feel safe riding your bicycle fast if you're wearing a helmet. You'd be more inclined to take curves on a mountain road at high speed no, I would not, Jason. He says you'd be more inclined to take curves on a mountain road at high speed in a sturdy SUV than you would in a compact car. I'm sorry, I'm not taking curves on any mountain road. I don't care what kind of car I'm in. I think falling off a cliff, I don't care what kind of car I'm in. I think it's just more metal to peel off to get my body out. In much the same way, the low interest rate policy of the Federal Reserve and other central banks around the world has made the market environment less risky, thereby prodding investors into behavior that's more risky. In years past, you could typically earn about 5% on your cash without any risk, other than losing your purchasing power to inflation. So you had to gain at least 5% to justify taking a risk in the first place. Seeking risk wasn't safe, avoiding them was. All that changed in the financial crisis of 2008-2009 when the Fed slashed interest rates. Along with other central banks, the Fed has kept rates near zero almost continuously since then. Now, keeping your money safe carries a cost. Loose monetary policy isn't the only force pushing people into seeking risk. Try recalling how frightened you felt as an investor in February and March 2020. That would be a great time to have a little skit, like a 3-second thing. Okay, you can't do it, can you? The COVID-19 actually, I can, Jason, because I do remember. The COVID-19 pandemic was raging. The economy had shut down. Millions of people had lost their jobs, and the S&P fell 34% in less than 5 weeks. Remember that? Who remembers that? I sure do. You actually scaled this account quite. I see you, Chris. I do something like this for a living, so it wasn't my goal to scale it, but I'm able to read the data and do things with it that I think most people don't. As I digress, let me get back to the article. I got really serious there for a second. I'm like, this is what I do. The COVID-19 pandemic was raging. I said that no matter what you think now, you were terrified then. Everybody was. And that's true. But the epic recovery from the COVID crash of early 2020 has reinforced the sense that markets are safer now. After the 34% collapse, stocks hit all new highs again, only 126 trading days later. That's made it all but impossible for most of us to reconstruct how afraid we were only about a year and a half ago. We see the past through a rearview mirror made of rose-colored glass. Brushing aside our losses creates a false bravado that makes us think we can weather the future with less fear than we suffered in the past. To stay out of trouble, ask yourself whether you are taking risks you don't need to. Seriously, and so I'm bringing this up because I think this is a good thing for all of us. Just look, things are raging. We can't time the market. I'm not saying we're in a bubble, but make sure that you're not falling for this trap that most of us are going to fall for, or most investors do fall for, and just thinking that this is how it is, and you're buying in now. I'll give you an example. I told you about Chewy. I bought Chewy, well over a year ago. It was great price. I knew what I was doing. I could be wrong, but I was willing to take the bet. I had a margin of safety, et cetera. Now, this past week, earnings came out. It spooked some of the analysts because they didn't match certain expectations. I dug into it. It didn't bother me, but it's gone down about 12% since. Did I have a moment where I'm like, oh God, I got to get out of this? Absolutely. But, and I saw someone say they're going liquid. Hold on, before you do that, don't forget about short-term capital gains. So if you're buying in, let's say if I bought Chewy 2 weeks ago, that would have been a mistake, but that's what people are doing. They're seeing things go up and they're not remembering that the people that have, like me on Chewy, that was over a year ago. So I've got plenty of room for it to come down and I'm long-term on it. So I'm not looking to take that money out for, 5 or 10 years if I take it out then. But it's easy if you're just, again, you're like, what do I do with my cash? Let me just buy more of this stock that's done well for me. It seems obvious like you wouldn't want to do that, but we do it all the time. But you forget that, wait a minute, it's, in the last, 12 to 14 months, the market's just been on a, ricocheting up. So you're actually buying with not much room or margin for safety. And I've been reading about the dot-com crash, and that was the thing. It's like these stocks, some of the stocks are still around today, but the market had so overvalued them, and there's this cascading effect where we see other people doing it, and you see something going up, and our brains are not that smart. We have to be really conscious of this. You're like, oh, it's going to keep going up, and we jump back in, or we jump in. But again, if you're buying at a not reasonable price, it could take a long time for you to get your money back, and that's if you hold. Most people are going to not deal with that 34% drop, with a lot of, as Charlie Munger said, a lot of equanimity. People are freaking out and selling, and you're paying short-term capital gains, and you're interrupting the compounding process. And that's why I think passive indexing is so smart for just about everybody. That's why Warren Buffett thinks it's smart. Because if you're a long-term investor, it might be high, I'm not saying it is, by the way, but it could be a high price right now. But is it going to be a high price in 30 years? And in the meantime, it's time in the market, not timing the market. I really believe that. That's helped me a lot over the years. So I wouldn't go liquid unless you bought a bunch of stuff that is speculative and you've done really well and you're just like, okay, I rolled the dice and got lucky. Let me get out. Like, I get that. But for everyone else, I don't know if that's the move. Garrett, that's a great question. Garrett says, how does Munger avoid selling when things get stomach churning? I have a theory on this I've never said out loud before. So Charlie Munger's actually dealt with some real tragedy in his life. When he was in his, I think, late 20s, maybe a little bit older, but he had a son. I think it was his son named after him as well, like Charlie Jr., who was diagnosed with leukemia. And it was they didn't really have cures for that back then. And, you basically just had to watch your child die a slow death. And, in this book that I read, he talked about he would just, see his son in the hospital and just walk the streets of Pasadena crying. And I think, when you lose, I've had big losses in my life, and I'm sure some of you have as well. I'm not saying that makes us all great investors, but I recognize that if you know what you're doing, you can deal with, some paper losses if hey, over the long haul, I know what I'm doing. And I think it puts it in perspective a little bit. Like, you think I care if, this number on this piece of paper is going to go down a little bit when I'm going to be investing for 30 years, and I really understand what this is all about, how this actually works. So I've thought about that, actually. He never said that, and that's just one of my thoughts about it. I think also when you're aware of the math behind investing, whether it's probability theory and just the way the market works, and how to evaluate a business and actually why stock prices go up, and actually understanding what's causing that over the long haul. I think that's helped me. That's one of the reasons I got so into this, is like, if I could just know the mechanics, I won't freak out. And I'll give you an example with psychology. Understanding psychology period, it helps me when I'm having a moment of irrational thought or feelings. And I did when Chewy went down 9% the other day. I thought about, man, I should maybe take some off the table. But I remembered, wait a minute, no, I bought, I'm still up like way more than I should be in this short period of time. And I thought I knew what the principles of psychology that explain that feeling. And so that helped me kind of get back and get calibrated again. And that's something I didn't have to this level that I have now, maybe 5 years ago. So that helps a lot for me, and it might not work for you, but that's just my story. But yeah, I mean, again, making sure you get the price right. Don't buy the dip if you still don't know how to evaluate the business. And I'm saying that not talking down to you. I'm saying that just to look out. Everyone says that, just buy the dip. Don't buy the dip if it's still overpriced and you're going to have to take 20 years to get back to even. Because if you bought the dip during the dot-com crash, you would have made diddly dick. Pardon my language. You could have bought the dip of Amazon, and it would have taken you, if you would have held out maybe another 20 years to get your money back, or to get even, I should say. And I'm not saying it was exactly 20 years, but I was just reading about the dot-com crash. I heard someone say this too. As a friend of mine works for one of the big Wall Street firms. His boss says something about buying the dip. You get sticky fingers. Let me check out these comments. All right. How have you invested in real estate? So, yeah, no, I bought I bought where I live. And I say that, I'm not into like trying to say, these people on Instagram, like, here's how I did it and all this. I'm not braggadocious about it. I kind of feel weird talking about it. I shouldn't feel weird, but, yeah, that was, it was a big decision to make. And for me, I looked at it from the perspective of, my investments and realizing that was a good, smart way to diversify. And I was reluctant to do it because it's a big commitment. And you have to know, I knew I was going to stay in the same city. I'm going to be in New York City, hopefully for a long time. I really I've been here for a while. I like it here a lot. But, thinking of it in terms of, what the opportunity cost was, as well as just, de-risking. And in New York City real estate, there's always ups and downs, but it's a very resilient place. Even during COVID, I put my escrow up right before COVID hit. And so then, it's like I talk about, you can't time the market. Ended up renegotiating though a little bit, which was, I'm pretty good at that stuff. I'm fair, but I'm like, this is ridiculous. Like the city, you're telling me that I have to, I could just pull my money out right now and you can have the escrow. That's kind of how the attitude I took, because I said, I crack algorithms for a living. Like, I think I'm going to go play the markets. And that wasn't a bluff either. I really meant it. But, looking back on it, it's kind of a ridiculous thing to say. But yeah, I mean, it was something that I decided to do it after I had to really conceptualize the idea, like, okay, I'm going to live in my equity. That to me was kind of what got me over the hump. And I was kind of stupid about the mortgage thing. I was like, but I don't want to be in debt. Like it took me a little bit to realize, okay, it's to understand. I had to do a lot of self-education. And I obsessed over it like I do about, this kind of stuff. And so I really, by the time I decided to pull the trigger, it was a good decision. And everyone I talked to who had done some sort of, buying where they live, they all kind of told me the same thing. They stressed out about it, but none of them regretted it. And I think also lowering your expectations. My home is not something I look at as, this is going to, be the best investment of my life. Like that wasn't the point. The point was to do something sensible with capital. And anyway, but I'm not a real estate expert. I see people on Instagram all the time, about rental properties and all this stuff. And again, not an expert, just a thought. That's still a lot of work. When people say I saw this guy and he's like, if I was 20 again, he's one of these like, I was living in a car and then I started a drop shipping company, like one of those accounts. And he's like, I was on the side of the road. I didn't have any clothes. I used to beat people up and take their purses, but now I'm a great guy. He was talking about, here's what I would do. And he's like, I wouldn't eat any food. I wouldn't buy anything new fashion. I wouldn't hang out with anyone. I'd save every dime. I'd buy a rental property. I'd flip it. And then I'd rent the other one out. And it's like, dude, that's a lot of work. Like you're acting like you have where is the rest of the time going? So I think trying to find things where that's another part of the investment process I think is overlooked. Is like, how much work is it going to be for you to realize whatever it is you want to realize from it? Another pro of passive investing. I put up something from one of these recently where I'm like, day trading it's not even enjoyable to me anyway. Like to wake up stressed out. I've got 10 monitors up. Not only does it not work long term, but it's there's other ways to make money that are probably not only more enjoyable for you, but it could be more lucrative. Anyway, I digress. Are you Spanish Mexican descent? I am not. I'm Italian. That's the Franco. But I have a brother who obviously has the same last name, and he was actually recently asked the same question. He got a call in his business. He got a call from someone who was only speaking Spanish, and they wanted to work with him specifically because they thought he was of Spanish Mexican descent. But I do, this for anyone that likes boxing. Canelo Alvarez, Canelo. I got the Canelo going. So maybe that's why you asked. Maybe it wasn't the Franco. No, actually, that was from Franco Moran. So yeah, I see why. Okay, Chris Nixon says, okay, I answered that. IH8 Ninjas said, I'm going liquid. We talked about that. I hope you don't do it unless you did bought some speculative stuff. How does Munger avoid selling? We talked about that. What do you think about the 2X and 3X S&P index ETFs? That's from Jay Trio. I hope I say that right. Meaning that they're overpriced right now. Is that what you're saying? I'll answer it for sure. I just want to make sure. Okay. Beware of the value trap. Here we go. Will says, what books do you recommend for investment fundamentals? What's up, Will? The one I read that I really enjoyed, I've talked about before, is the Warren Buffett Portfolio by Robert Hagstrom. I learned about it because Charlie Munger recommended it at the 1999 Berkshire meeting. I can't believe I remember this stuff. Awesome book. The Intelligent Investor is good to read. There's 2 chapters you should read from that, and I'll tell you which ones. And this is from Warren Buffett's recommendations. This newsletter I have, by the way, on Substack, what I've done is I'll find something interesting. It's kind of obscure, but I think that's good to know, and almost from my own process. And I had some posts about it. So, I've learned that if I write about something, I really remember it. But let me just tell you what chapters that Warren Buffett said to read. I love how I'm I remembered it, and then I have to look it up, but I remember part of it. Now, I just want to be accurate. I don't want to say the wrong thing, and then you guys, I don't want to waste your time. Okay. Where were these? Bear with me, guys, and we'll get this. It's 2 chapters that Warren Buffett says you should read from The Intelligent Investor. And this is, a classic book, Benjamin Graham. There are parts of it that don't apply to today, and that's a good thing to remember because I think it's easy to think that it's not formulaic, but there's some big concepts here that are, they're time-tested and they still hold up. One sec. Substack, by the way, is awesome. If you guys don't know about Substack. Okay. He says, and I'll read it for you. This post reads, it says, The Intelligent Investor by Benjamin Graham is universally regarded as the book about investing. I was reading through the transcript from the 2008 Berkshire Hathaway shareholder meeting this morning. Nerd alert. And I came across a nugget from Mr. Buffett about Graham's book. Here's a quote. I will tell you what changed my own life on investing. I started investing when I was 11. I first started reading about it. I believe in reading everything on it, in sight, by the way. And I first started reading about investing when I was probably 6 or 7 years old. I think I was still learning to read at 6 or 7. He says, for about 8 years, I wandered around with technical analysis and doing all kinds of things. And in another speech, by the way, he would try to read the charts, all this stuff that he realized doesn't work. And he said, then I read a book called The Intelligent Investor. And I did that when I was 19 down at the University of Nebraska. And I would say that if you absorb the lessons of The Intelligent Investor, and this is what he says, I recommend particularly Chapter 8 and Chapter 20. Then you will not behave like a lemming, and you may do very well compared to the lemmings. I think it's as great a book now as I did when I read it earlier in 1950. He says you'll never get a bad result if you follow the lessons that Ben Graham taught in that book. Now, Chapter 8 is about market fluctuations, and Chapter 20 is about the margin of safety. So Chapter 8 and Chapter 20, those 2 chapters from The Intelligent Investor would be something that I recommend reading for some fundamental, or at least fundamental ideas. And that's to Will_ambitious forever. I have one other post here that just made me think of. We went through and found every book recommendation. This is sounds so nerdy, but I think you'll like this a lot. So Warren Buffett has recommended 31 books at the Berkshire Hathaway meetings since 1994, and this is not including, I think, the last year or two. And so we made a list of there's 7 books that he recommends more than once. So I will read those to you. The first is Common Stocks and Uncommon Profits That's by Phil Fisher. Next, we have The Path to Wealth Through Common Stocks, another Phil Fisher book. The Intelligent Investor, which we just talked about. Ben Graham's biography, which I own. I have not, I've flipped through it a little bit, but that's on my list. And that's also by Janet Lowe, who wrote the biography about Charlie Munger, Damn Right. And then he says Common Sense on Mutual Funds by John Bogle. I own that. I recommend that one as well. It's like, only buy it if I also recommend it, right? All right. The Essays of Warren Buffett, Lessons for Corporate America. I own that one. It's all right. I mean, it's got a lot of good stuff in it. It's just, it wasn't like, it's not an exciting book. The Essays from Warren Buffett I mentioned. Okay, The General Theory of Employment, Interest, and Money. And that is the last book. So 7 books he recommended more than once. Check that out. It's on our Substack, cmqinvesting.substack.com. CMQ as like Charlie Munger quotes or Compound Money Quietly. Okay, let's see what else we got here. How long have we been on? I feel like this is just flying by. Oh, that's Brad says, one sec, guys. I want to make sure I go in order. Okay, so from Real Josh says, who are some of the people who inspired you other than Charlie Munger? Inspired me just in general or like for investing? Charlie Munger is definitely, I mean, I have to put him number one. I mean, I don't have any other quotes pages. Well, actually, that's not true, but this is, that was the first one. That's the one that I, am adding to all the time. So it's Charlie Munger for sure. There's people that you'd be surprised that inspired me. I don't know. I'll tell you, if you want to read an inspiring book and talk about someone who this is going to catch you guys off guard. The autobiography of Malcolm X. I read that when I was 20. He went to prison. He was illiterate. He learned to read. He read everything. Like he just was read. He would stay up all night. It was like it opened his entire mind. And when he came out, he was like, I mean, if you ever watch a debate with Malcolm X, I mean, crazy, crazy smart. And a lot of people falsely think that he was, he hated white people and all this stuff. Towards the end of his life, which was not very long because he was assassinated, he had this incredible experience where he did his Mecca. I don't know if you call it. I know you go to Mecca. I don't know if it's called. Again, he went to Mecca to do his pilgrimage, and when he was there, he saw white Muslims. And around the same time, his hero, or his mentor, the person that he converted to, he became a Muslim when he was in prison. And this is a guy named the Honorable Elijah Muhammad. Again, I'm not saying anything bad about anything here. I'm just telling you what I know from the book. But he followed this gentleman, and then he found out that what this guy was doing wasn't lining with what he actually was preaching. It was actually the total opposite. So he got this horrible feeling like where, oh my God, you're not who you said you were, and I've been following you. And then this kind of coincided, or there was a confluence here where, he was also having experiences with white people who weren't, horrible. And, he wasn't this extremist that people sometimes think he is, because they would contrast him with Martin Luther King Jr. But anyway, his story I remember just being really inspired by it. And again, I wasn't reading it for any political purpose. It was just a book that somehow came across my way. And just really, really interesting book. And he read all the time. And his work ethic was insane. So if you ever need a kind of a kick in the ass, check that book out. Okay, Warren has asked, this is from Brad. He says, Warren has asked why he doesn't have more homes, and he said he doesn't want to be a property manager. Amen. I mean, look, keep it simple. I know people that have all sorts of homes, and they always have stuff they have to fix, and it's a pain in the ass. Sorry, I guess you guys can hear ass. It's okay. Sometimes I forget this lives on the internet forever. Harish says, far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. And that's a Peter Lynch quote. And he says, how do you handle the current situation where the market's overpriced? I think stay the course. Don't, try not to buy things that are overpriced. But if, just expect at any point, there's going to be a correction. But if you're relatively young, that's what we all have to kind of support each other through when that stuff does happen. And I think that's when the CMQ community will be really important, because we don't want to have, suddenly that's where people lose all their money, is they sell because they get scared. And it's understandable, but I think when you keep the first principles in mind and you remember we're playing the long game, compound money quietly, that's meant to be like a mantra almost, right? Like it's about time. Time is it's time arbitrage. So I think if you're if you're in the markets and you're not owning things that are overly priced, or you're not buying into things because of the herd, if you're not falling for those very easy traps to fall for, then we gotta stay on, keep going. Let's see what else. Smart Jay Trout says, smart point about work it takes to maintain properties. Hey, thanks, man. James says, would you consider organizing an NYC meetup? Absolutely. I forget sometimes that we all live in physical locations, but absolutely. That'd be really cool if there's interest in that. That'd be awesome. That'd be really cool, actually. It's, it's like, next thing you know, we're doing concerts, festivals. Okay. I'd rather invest in REITs. Yeah. I mean, just make sure, don't just invest in it because that REITs are real estate or that they're a thing. I think a lot of times, we don't dig into, wait, what is this? And what am I buying into? And is this a better long-term choice? Just keep in mind your long-term perspective. And look, if you aren't doing don't have the time to do all the learning and the research and everything else, like don't shy away from getting advice. I would just use something that's much more like low cost. I think there's all sorts of stuff now. I don't know if I'm probably not going to do it personally, but I might look into it. Vanguard has a like digital advisor, and it's like 0.15%. You can do the first 90 days free. So, just something to think about. I'm not recommending anything, but, nothing. And then talk to people who know. I try to ask people all the time who are much older than me. On the podcast, we'll do this. I'm going to do interviews probably starting in October. And I'll ask, what's the biggest mistake you made with money? What's this, if you could go back to your 20s, what would you do differently? Because I think those conversations are really important, and we can learn vicariously from other people's mistakes. 2x, 3x is a long-term hold. I'm Jay Trout. I'm so sorry, man. I'm still not sure what you mean. I'm just stupid, so I don't know what you mean. 2x, 3x is that a company? Okay. G Firestone says, what should a 15-year-old with some income do to get ahead financially? First of all, if you're 15 and you're into this page, man, that's awesome. I'm super pumped about that because, listen to what Charlie Munger says. Start doing that. And trust me, I'm 33 and I think some of this stuff I was already figuring out and had figured out, but the Charlie Munger stuff just was like, I just kept doing what he said and it worked. But financially, I think, look, if you have some income, I don't know if you're allowed to open up a brokerage, but save. Don't do anything crazy. I think something else you could do, it's not to get ahead financially, but just to learn is, try to start a little business with some friends. I had an auto detailing company that some buddies of mine, when we were like 18, made just to make it was to make money during the summer. It wasn't like a long-term thing, but I think, I'm entrepreneurial, so that's part of it. But, you don't have much downside. And if you could find a business that doesn't require a lot of upfront capital, and all we needed was, we bought this really nice auto detailing stuff. People had water at their homes. We plugged in the hose. We had some vacuums. It was very easy to do from how much money we had to put up. And it was fun. It was a fun way to bond with my friends, and we did a good job. You learn the marketing part of things. You have to make it work. And I think that was something that when I was younger, I was always trying to start little businesses, and I wasn't very sophisticated about it, but I always had that kind of instinct, and I enjoy that stuff. And you learn a lot that way. I think if more people started businesses, they would, one, be more interested in stocks and be able to, probably we'd be better at reading about businesses. And they really go hand in hand. Like I've become so much more sophisticated. My business was doing great and is doing great, thankfully. I'm not saying that as a brag, but as I recently read this book on financial statements, and just reading that book, I was like, wow, there's some things here I never knew about or thought about that now I look at my business in a more sophisticated way. And reading about other businesses like 10Ks, that's helped me just think bigger. So I think that's a good one. But yeah, save your money. Don't get into don't do drugs. Don't start spending money on things that are unnecessary. But to get ahead financially, if your parents can open up a Vanguard, fund for you or something like that, and you put it in that, I think that'd be, man, if you could start at 15, doesn't matter if you're putting in really small amount of money. You just have to make sure that you're okay with that and not touching that. I think a lot of people think they are, and then they look at it like it's a cash account, but just put it in there and say, I'm not going to touch this until I'm, until I'm really old. And that's going to work out really well, or it should, probabilistically. But thanks for joining, man. That's really cool. I'm super excited. I realize there's a lot more. I've said before, some of this content, it's what I think about myself 10 years ago, and I see like the Robinhood stuff and some of the more speculative stuff. And I'm like, man, I would have totally gone for this 10 years ago. And it's not just because you're young. It's because in part two, and this is like science, for males, our prefrontal cortexes aren't fully developed, they say, till we're 25. So our decision making in itself is already kind of limited. And then when you're past 25, it's still limited. But they call that the executive part of your brain. So that's why younger guys can make a lot more risky decisions, and that's another reason why Robinhood is just kind of gross, because they are attracting that audience. And it's almost like, sure, everyone makes their own decisions, but you've heard what I have to say about Robinhood. If not, check the podcast. I don't want to bore you with my thoughts on that if you've heard it already. Okay, let's see what else here. Ben Graham's biography is excellent, says Jay Trout. I'll check that out. I want to see, someone said to Franco, they said brave. I want to see what they were saying that to. Okay, one of Charlie Munger's quirks is extreme concentration. 3 great companies, securely rich. Do you see many people with the conviction to do this? That's from Gareth. Probably, I just actually, let me see. There are investors who do that, but it's not the norm. Now, with one thing to keep in mind with the third of those companies, which is Li Lu's fund, I'd imagine that fund has more than one stock in it, but I could be wrong. But I think they've invested in more than one thing. So it's, technically speaking, that's a fund. But, it's Lee Kuan Yew and Li Lu. It's both Lees, but they're spelled differently. Who else? There's a thing I posted up a while back about diversification, and I found what all these different legendary investors had said separately about, what's the ideal number of stocks to own. Give me a second. I'll read that to you. Hang tight, guys. Okay. Just found it. Okay. How many stocks? So here's what I wrote. My focus portfolio, and you'll know what that is if you read the Warren Buffett portfolio by Robert Hagstrom. My focus portfolio contains 11 individual stocks. I chose them based on opportunity cost and opportunity cost alone. I personally think you should only buy individual stocks when you are certain you'll be able to handle big swings in the market. So here's what these legendary investors said about how many stocks to own. Start off with Phil Fisher. He said less than 20. Quote, for individuals, any holding of over 20 different stocks is a sign of financial incompetence. Peter Lynch said between 3 and 10, and I quote, in small portfolios, I'd be comfortable owning between 3 and 10 stocks. Warren Buffett said between 1 and 10. And I have 3 quotes here from Buffett. Warren Buffett, all you can eat buffet. He says, if you find 3 wonderful businesses in your life, you'll get very rich. And if you understand them, bad things aren't going to happen to those 3. Next quote, he says, with each investment you make, you should have the courage and the conviction to place at least 10% of your net worth in that stock. And then the final quote here is, a lot of great fortunes in the world have been made by owning a single wonderful business. Make sure this is still, wow, this is going to be a long podcast. Next up, and finally, Charlie Munger, and I have 2 quotes from him. The first is that I find it much easier to find 4 or 5 investments where I have a pretty reasonable chance of being right, that they're way above average. I think it's much easier to find 5 than it is to find 100. And then finally, he says, the very word diversification, which is taught in every business school as the holy golden grail, I consider almost asinine. I'm only interested in investing where I have some sort of advantage. I think the idea you have to have a big diversified portfolio, that's fine for the ignorant people to be fully diversified. But if you actually know what you're doing, I think 3 investments is plenty. And I use some mental models here that apply to this. The law of large numbers, I said, as the sample size grows, the mean gets closer to the average of the whole population. So, diversification by itself is going to get you closer to average. So if you want to do above average, there's not really a smart way to do it if you're owning a basket of 100 stocks long term. Regression towards the mean or reversion to the mean, sometimes people say it like that. I wrote, if a sample point of a random variable is extreme, a future point will be closer to the mean or average on further measurements. Kathy Wood, Prime example. I think Cathie Wood's downfall will be an example of reversion to the mean or regression to the mean. It's just, that's how the world works. I wrote a multi-channel distribution network, and that is a sales and retail strategy that is designed in part to minimize risk. And that is, again, where they're using, that's where diversification is at play. And then finally, backup systems, a data protection technique to protect data from loss, corruption, theft, and attack. I realized when some of those models, one applies to like Y diversification, one applies to Y concentration. But if you want to get ahead in anything, you need to concentrate. Like I could come up with, look, I'll do the multidisciplinary thinking right now. So let's think about what examples, what big ideas or general big concepts or proven ideas, show us why that works. The first thing that comes to mind is in photosynthesis. If there's more light initially focused in on the plant, it actually increases the growth. Like, so it's the initial ray and the strength of the ray and the focus of it is stronger. You see more growth. You see that another example would be like a magnifying glass. If I went outside with this book and a piece of paper and then I just held it up to the sun and I was there all day, it would just get warm. But if I have a magnifying glass and I let it concentrate that ray, I can start that little fire. And so let's think what else though. Probability theory would show us this. So I'm really flexing right now. I've been doing my homework. So based on my math, the prior probabilities that you pick a stock that beats the average of the market, meaning over a 10-year period, it's about a 10% chance. So the idea that you're going to pick, let's say, 3 winners in a row, 3 individual stocks that are going to do better than the average of the market over a 10-year period, it's 10% times 10%, that's 1%, times 10% again, that's 0.1%. So the base rate, the prior probabilities are that. And so if you want to improve the probabilities, circle of competence, easily understandable business, you're certain that the earnings are going to be materially higher in 5 and 10 years. One of the ways that Buffett and Munger do that is they pick industries that are not fast changing, where they can say, hey, like they've mentioned Wrigley's chewing gum. Pretty sure people are still going to chew gum as one example. Coca-Cola was an example of that. They had just a massive distribution network. They had a certain, for a variety of reasons, they were going to keep selling Coca-Cola and they weren't going to have much problems doing that. And even as you've seen them diversify now, where they have other beverages that have now taken the place that are more healthy. But again, that distribution network. But the probability thing is huge. And that's actually the root cause or the root of a lot of the cognitive biases is we're terrible at thinking about probabilities. We're easily misled by information that's not relevant to, what we're trying to predict. And, that's where the Kahneman stuff and the Tversky stuff from 1974, that's where it all originates. I know I just jumped around a little bit, but yeah. I found that in business, by the way, when I narrow the focus of any business I've had, that's always been a better approach. I'm not saying it works universally, but if I'm trying to, let's say, offer 12 services, in a business, right, you want to have a competitive advantage. You want to have a differentiation. You want to be better than your competitors. And so it's tough to be better at anything when you're trying to do 12 things. It's tough to be the best at anything. It's like LeBron James could probably go play football, right? But is he going to would he still have been LeBron James, who is still playing at a championship level today, if he'd also been playing football? You see what I mean? So that's an example of just thinking with these different models. It's an idea that really works. In terms of if you want to do better than the mean, you need to focus in on, you need to narrow your selection. You need to concentrate. This, as Buffett says, as Munger says, the secret to investment, it's knowing where to, I think he said de-diversify, or again, I know all the quotes, but I got that one wrong. Diversification is great for most of us who are, and again, in the form of passive indexing, but diversification like these thematic ETFs, that's not diversification. That's 60 stocks that all are exposed to a certain sector. That's not, think about the probabilities that all those work. Now, here's another model that we can think about that proves this idea. In any industry, any new industry, the automotives, you could look at radio and television. You could look at the railroads or the trains and railroads. You started with a lot of different companies, but inevitably or eventually it was all the winner. It was kind of like 1 or 2 or 3 were the winners. I've used that example about the auto industry. In the 1930s, there was like 2,000 different automakers, and it was seen like, driving in cars, that's the future. And that was correct, by the way, because we have roads everywhere. We were talking about BYD earlier. But in 2008, there were 3 automakers left, and 2 of them had to get bailed out by the government. And so the idea is that innovation is great. It changes the world. It can have a huge impact on society, but it's really tough for investors. Most investors get killed trying to pick the winners. Anyway, I hope you like that. Okay. Let's see. Ooh, we got some more stuff here, guys. Sorry, I have to scroll down to find the latest ones or the last, so I go in order here. Okay. Do you invest in crypto or do you stay away from it? I have a little crypto. I'm a little bit. I like the approach of 1% of your investable assets. To me, that's very I've had good timing with crypto, which I'm not saying is because I'm timing the market, but I just when Elon Musk was starting to talk about Bitcoin, and it would sway 30%. I was like, I'm done. I'd already done really well with it, and I was like, I don't want to get greedy here. If I'm up 400%, like take some chips off the table, and I also just I don't feel solid about it. And I think this is just my opinion. I think blockchain is the future. I think crypto is really interesting. I think, it could be no one can predict the future. But to me, it's definitely totally speculative. And, that can be fun for people, but I think you just need to be really careful about how much you're putting in. And it seems for folks that don't study like the bubbles and any of this stuff for that matter, I think it's easy to think that, it's a easy way to get rich. And there's been these periods in history where everyone's kind of fallen for that. It's really hard to see somebody. I had a guy I know, he bought an NFT for 17 grand and he flipped it for 40 grand the next day. And I started being like, I could get into NFTs. And I was like, wait a minute, wait. I don't want to play that game because again, that's just not, it doesn't scale. I'm big on, if it doesn't scale, I don't want to get involved. If I can't, if it's just short-term stuff, there's no point. There's a lot of too much luck involved, too much chance, and there's a high probability that you lose your money. Just because you see people, and that's another thing about the probability thing. I'm getting really excited. So the reason people jump in, and one of the reasons is because even though I could tell you, hey, there's like a 80% chance that if you buy, let's say some altcoin today, there's a 80% chance that you lose all your money in 5 years. Within those 5 years, you lose just about everything. But if you're seeing someone talk about their Dogecoin and they made all this money, that is an example. It's a recent availability bias. That's comes to mind. So you're seeing that and you're disregarding the prior probabilities. Same thing with picking individual stocks that would beat the market over a 10-year period. People will look at the last 10 years and be like, man, if I just bought Domino's or if I just bought Netflix. But, let's say there's a 10% chance you can pick a stock that beats the market over a 10-year period. That's a 10% chance. So there's a 90% chance that it doesn't, and you would have been better in an index fund. But seeing these examples of people, having these wins or hearing about the stock or seeing Cathie Wood, it's availability bias. And so we disregard the prior probabilities. And that's a really big reason why we screw up. And I just think that's fascinating. Okay, do I invest in crypto? So yes, I have a little bit of crypto. I'm not against it, but I don't like actively think it's a really it's not a great investment in my opinion. I could be wrong, but my principles as to why I think that is the case, I stand on. My logic, I feel like is solid on that. Okay, do you prefer distributing or accumulating ETFs? What do you mean by that? Accumulating, if I'm misinterpreting something, just let me know. I don't want to answer something just because I think I know what you're saying, because that would just be dishonest and not helpful. Gareth says, thanks so much for this excellent work. Last question. How much cash percentage would you hold to protect against this high market? I appreciate you asking. That's a great question. I think it comes down to what makes you comfortable. I've said before, I'd like to have a certain amount of years in cash, maybe 2 or 3 years of expenses available just to keep me sane if something crazy happens. So I can't give myself an excuse to sell because I have to pay a bill. Now, I recognize if you're younger, that's not possible in most cases. Something I worked towards in my early 20s, mid 20s, and it actually allowed me to start my business, is I worked towards having 3 months worth of expenses in an emergency savings account. So if you're younger, and that's something to work towards, just try to start with 1 month, then get to 3 months. And that's, if you ever have a job, you lose a job, not because you did anything, but maybe you're at a startup and it didn't raise a Series B or something like that. There's all sorts of stuff that can happen. I don't want to come up with all the reasons why you could lose your job, but my point is, that gives you the time to be patient. That gives you the ability to be patient, to to really not have to jump at whatever you can get, but actually take your time. And that's the biggest gift you can give yourself. Now, for as far as like investing, I think whatever number of months or years of expenses that you need covered, so that you don't have to sell what you've invested in. Now, just make sure you're not buying stuff that you don't know anything about the price on, or you bought it at a high. Just be really careful that you're not falling for that trap, because I don't want to say that if your stocks go down 90%, don't sell. But if it's actually going to go to zero because you didn't do any research, every situation is unique. But I'm also, for my business, I now see my business as almost like a stock, where if I have a great business where it produces capital that it just goes back in the business and makes more. It doesn't require it. I mean, it's expensive to have a business in the city. I have offices. I have people that work for me. I have payroll costs, all that stuff, healthcare. But as far as like, hey, if I've got X amount of cash, I could also put that into my business. I started thinking of it like that, which is weird, but you'd think that would be more intuitive. So I think there's different places to put it, and so there'd be other reasons to have that as well. I just like having enough cash to where I don't have to do anything where I can be independent. Meaning, like I'm a worker. I'm not looking to go on a beach somewhere. And no, I mean, I should and get a tan, but I think the ability to say no and pass on things, to me, that's the ultimate freedom. That for me, that has been what I wanted more than anything, is to pick and choose what I work on. And again, it allows you, kind of like Charlie Munger says, you can wait for the better opportunities, and the ability to wait. And this is me now, but the ability to wait, that's a real advantage, because most people have to jump at whatever is offering them money now, and something better could come along, or you have more time to learn, or more time to gain some insight that's going to get you ahead. I mean, everything is a competition, it's constant competition. So I'm always thinking about, what do I need to do to get an edge for the next 5 or 10 years? How do I destroy everyone? Okay, what do you think about crypto? You heard me say that. Compared to stocks, the page is sauce. Thank you, man. That's I want to get like that as a testimonial. Check out the podcast, man. Compound Money Quietly, CMQ Investing. That's what I'm recording for right now. I've got a YouTube channel too, CMQ Investing on YouTube. Subscribe to that. Maybe I'll put more of these on YouTube, because I think people are there. And apparently you guys don't mind looking at my face while I talk. So crypto has much more upside than stocks. Yes, maybe, but also a lot more risk. There's not many stocks I would ever think of buying that I think will go to zero. You don't know that with some of the cryptos. There's a long history of speculative bubbles, and you could make a really strong argument that at some point, when the whales sell, whether it's Bitcoin or Ether or whatever, suddenly that price goes down. You get a cascade, but in the opposite direction. So everyone starts selling. And that's what happens. I'm not saying that's the case for sure. No one knows, but there are certainly, you could make an argument. The question is, how do you know when to get out, know what you want to achieve, know what makes sense for you, and just try not to lose money. The longer your money grows and you don't interrupt that process, the longer it can grow. There's not many cryptos I can buy and hold for 40 years, or that I feel comfortable doing that with. That's not the case with the American economy. There'll be ups and downs, but, I believe in, as Buffett says, the American tailwind. But appreciate saying that. That's from Eberhard fan. I'm sorry. I wish you could just like hear how you want to have it said. But he said crypto is much more upside than stocks. This page is excellent. I really appreciate that. I hope you don't mind me disagreeing with you. You're like, this page sucks. This guy sucks. Grow some hair. Love your page from CF. Again, sorry, I just don't know how to say your name. I want to say it right, but SIAHF says, love your page. Appreciate it. Thanks for being part of it. IH8_ninja says, I use Stash. I actually know some people that work there. I don't know much about Stash, but I do know some folks there. Iman himself says, sup, I love your IG page. Thanks, man. I see you in the comments. Appreciate that. Good to see you. Garrett Moore says, great to hear you apply mental models to situations. 100%. I think that term mental model is misunderstood as well. Episode 3 of the podcast, I set out to explain what it is. And that's actually on YouTube. I put it on YouTube as well, and it's gotten a lot of, considering how niche it is, it's gotten a lot of great feedback. Because I felt like across the internet, it's misinterpreted, and people will say things that aren't models. They'll call them models, and I'm just really like nerdy and technical. I'm like, no, that's not right. But I think it's one of the reasons people have a tough time grasping the Munger concept about worldly wisdom is because there's not the correct definition of mental model. And I think just call them models. That was something that came out. I put a lot of time into that. And, again, if you can explain something in a way that, I know is true. I found every single time Munger has talked about models, from his first speech to every Q&A question he's gotten over the years. And he said that worldly wisdom concept, the idea of multidisciplinary thinking, he said that his approach seldom gets through to people, even really smart people. And I think a lot of it has to do with that core piece is you have to practice and use it, but people aren't able to fully get what the model is in the first place. Because it's not just, there's other ways to think about models. And I actually bought the book where that concept first originated from. It's called the explanation. What's it called? I could go get it, but yeah, it was, a model is a generally accepted idea or concept. Typically you could find it in a textbook of any major academic subject. When he says the 100 models, he literally just means the 100 big ideas from all the major subjects, like the second law of, I'm trying to think, a good example would be, gravity is one. It's some really simple stuff, like just understanding all the basic ideas from all the subjects. And the point is that in academia and in life, there's more money in specialization as we go along. And so what happens is there's these silos in academia, and you can understand the world better by understanding what every department has figured out about the world. And so when you think in a multidisciplinary way, you're able to actually see things more clearly, more rationally, because you're factoring in all the situations. It's like, otherwise you're looking at the world like this when you should be looking at it like this. So it is like, it's a very kind of like abstract, qualitative, outside of the box way of thinking. But, he has said the multidisciplinary approach has made his life, not only, he says, it's made him enormously rich, but he says it's made him more constructive, more helpful to others. And so he gave this talk in 1994 when it's like, he literally is like, this is the key to my life, was doing this. And so, when I came across that, it was like, oh, I want to be able to like help more people understand this, because, that's probably one of the biggest Charlie Munger things is being multidisciplinary. That's, as an investor too, he says that his advantage was not in specialization. It was knowing the big ideas from all the disciplines. That thing, what he said about BYD, we read earlier, how else would he know all that about Jack Welch and Thomas Edison? It's because he's a biography nut, and he's not just reading about one thing, but then he uses it. And that's the key thing too, is don't just know the ideas. Like you heard me talk about psychology earlier. I'm sharing that with you because once I learned some of these ideas, I start applying them as much as I can, because they are all really simple ideas. And we often have learned them at some point in school, but it's to pass a test, not to say, they don't say, hey, probability theory, you can actually make better decisions in just about anything if you just think about the prior probabilities. You just learn how to solve the problem. Anyway, I digress. ETFs then instead of stocks. But do your research. It's not, I wouldn't say anything just like blanketly or blanket statements like that, but there's arguments that the ETFs are cool, but Admiral shares are cool, and Vanguard as well. What is MMAT? That's from looks like Che Lemon something Manhattan, is that right? It says buy MMAT. I know we're getting big when people are promoting stocks. That's good. Someone's going to come in here and say, I have to say, I'm so grateful I met, what was it, like Mr. Pierre Saunders for helping me turning $1,000 to $11,000. I see those all the time. I feel like someone could make a really funny spoof on that. Do you try to avoid, so this is from Brad. He says, do you try to avoid looking at the market movement daily? I do. It's just noise. Don't get me wrong. If the market's down 50%, I'm going to turn on CNBC. But, generally speaking, I don't have any tickers up. Lamelli says, your page is great. Thank you. Gino asks, do you believe in creating your own luck? Like what the guy in Titanic? He's like, a real man A real man creates his own luck. Leonardo DiCaprio. Yeah, I mean, look, I like the expression, the harder I work, the luckier I get. That's been my experience. Greetings from France. Hello, France. Greetings from New York. Hello from Dallas, Texas. What's going on, Dallas, Texas? This is the coolest part about IG Live, by the way, is just seeing how we're all in these different spots and we're connected on some Charlie Munger wisdom. This has been great, guys. This has been going for a while. What a nice way to spend a Sunday. Hanging out with the CMQ investors. This has been 3 hours. Holy, I can't believe that. Now, here's a question. Should I upload all 3 hours to the podcast? Is that ridiculous? Do you want me to edit it? Just tell me, because I was reluctant to do this because I like to make the podcast a certain way. Let me know. Should we 3 hours of just IG Live? I can also take some of the videos of IG Lives and put them up on audio format. I have the good mic going. I've got the whole setup. So, okay, so 3 hours up there. I'm going to say at the start, I'll probably do a little intro and say, they said to do it, so don't judge this. I really care that the audio is, we're really making something high quality. Definitely, Brad. I definitely agree with that. I'm glad you said that. I watch I do this, and then you guys all give me 1 stars. You're like, this podcast sucks. It's really gone to hell. It used to be good. Then Connor the overconfident investor, crashes Lamborghini. Maybe in this episode, Connor will, he's going to come out soon. Connor's going to be back. He's healed up and back more arrogant than ever. I should do a podcast as Connor but act like you guys will know it's a joke, but I'll put it up like it's serious, and I'll dress up like I'm that guy, and I'll say my name's Connor, and I'll create a whole identity, and he'll just say the most outlandish stuff, but be dead serious. And we'll have other people who are also me agreeing, like, that's a great idea. Those are all my voices, by the way. Someone who came by my office, who's a guy that works in my building, at our office building, he's working on a podcast, and I was like, you got to come up and check out what we're doing. And he came up, and I was going through an episode that I was about to publish, and I started imitating something where I was one of the voices, and he's like, wait, that's you? Like, all those, that's the secret is, and you guys might already realize that, but I thought everyone did, but apparently not. So I'm like the hillbilly guys, Jimmy New York, and then Connor the overconfident investor. And then also the abusive wife, which was subtly put in one of the episodes where again, it all happens randomly. It's not like you should see the process. But it makes it more entertaining for me even recording it, because droning on about some of these topics when I don't feel your guys' reaction doing it. This is way different because I'm like, I see you giving me like thumbs up and stuff. But yeah, Connor, and the reason for Connor the overconfident investor, by the way, is it's like Ben Graham's Mr. Market character. So, that personification of an idea, it really helps you remember it. And, overconfidence, we have to avoid it. So the idea of this is like this pompous idiot, who's, just buy the dip. What I said, and again, these are all like freestyled. So I said, what was it? I bought the dip twice. Call it double dipping. Like something like that, but Dogecoin. And I'm glad some of you find it really funny, because it makes me laugh. It makes me laugh listening back to it, because I'll forget I've interjected that, or I'll have like a really quick little like snippet of something that just the episode about Warren Buffett's humiliating Berkshire meeting. There was a line that I was reading from about once the crowd settled down, and I had like a quick second of that crazy scream, like everyone's like ah, and then there's stuff that it's like too wild to put out. Like I'll have to kind of take some stuff out. I've had that, the first time Jimmy New York showed up and like beat up his stockbroker. I initially had it like he like walks in and he's like, yeah, real nice office you got here. And he's tapping on the windows and he breaks the window with a bat, and you hear the wind blowing in. And then he throws the guy out of the window, and the guy lands in the maintenance shed. And then you hear those guys, the hillbilly guys. They're like, mister, you okay? And it was like, all right, this is just too much. It's too violent, basically. I didn't want to have an explicit podcast. If you're unfamiliar with the podcast, by the way, that last 2 minutes here probably sounded like, what the hell is he talking about? But yeah, check it. It'll pop up from time to time, and it'll catch you off guard, hopefully, and it'll make you laugh. At the very least, you can laugh at my expense because it lives on forever. So, I'm sure it'll be like trying to just working with a new client. They go, wait a minute, you're very offensive in that podcast. On that note, guys, I got to get thanks, Brad. I appreciate it, man. Brad says the podcast is great. Really do appreciate that. Like I want to put more time into it. I mean, I think there's a really good future in it. I enjoy it. It's a cool way for us to, I think keep building on these ideas and just, I can't find a lot of stuff like it. And I think when we do interviews as well, I'm going to bring in, in like the line of Charlie Munger, bring in people from all different lines of work, because money is something that we all relate to. We can all talk about it. And I think, there's ideas about money that don't all come from the investment world. There are people that have really smart ideas about money because they haven't been indoctrinated by, maybe academic thinking on it. I know for me, I would just, I didn't, like I said, I wasn't formally trained in this stuff. It's a very Charlie Munger-like thing. You can learn things. Franco says, thank you for a great Sunday. Same to you, man. Since we're 3 hours in, I should probably cut this off. Thanks for everybody for hanging out. I'm trying to do these more. They're fun for me. I'm glad you guys like them, and I'll make sure we repurpose this content. If I don't get this up on the podcast tonight, I'll aim to get it up tomorrow, because I might have to add a couple of things. But yeah, we definitely will be doing the video interview format for sure. I've actually just bought a camera and a nice little light setup, so we're going for it. And Jack Williams says, thanks, man, you're awesome. Appreciate that, man. Glad you're enjoying it. I'm like, you're awesome too. We're all awesome. Overconfidence. Overconfident investors. I'm gonna go buy a bunch of individual stocks. Thanks, Jack. Jack says favorite account on Instagram. That's tight, man. Appreciate it. I mean, again, it's I like the content too. It helps me, so it's just cool to see it reach people like this. All right. On that note, should I end it like the podcast? My name is Chris Franco. This is Compound Money Quietly, the CMQ Investing Podcast. Thanks for listening. We'll talk soon.